In order to make or to calculate the total revenue subject to the tax, you need to know that there are four types of adjustments, which are expenses approved by the law but not included in the income statement, expenses not approved by law but included in the income statement, revenue subjected to tax but not included in the statement, and the final one is revenue not subjected to the tax but included in the income statement. The following table shows me how to apply the four types of adjustments. The first part is the accounting net profit, or what we call it the AMB. The accounting net profit is the net income from the accountant point of view, and we can find it in the income statement, and also it is given. So I'm going to add revenue not recorded but subject to tax, and I'm going to add expenses recorded but not approved by law. Then I'm going to deduct revenue recorded not subject to tax and deduct expenses not recorded and approved by law. The result will be called adjusted taxable net profit. It is not the final one. So I'm going to deduct the tax exemption from the adjusted taxable net profit to give me the taxable net profit. The taxable net profit is multiplied by the tax rate, is the unified tax rate, to calculate the tax due. The first part is how to determine the revenue subjected to tax. According to Article 17, Paragraph 1, revenue subjected to tax can be divided into three main categories. Number one, current activity revenue. Second, casual or subsidiary revenue. Or the final one is capital gain. Let's discuss the first type of revenue, which is the current activity revenue. What does it mean? It means revenue resulting from the main activity of the company. These revenue are characterized by periodicity. For commercial and industrial companies, these revenue represent the total profit realized by the company from the sale of goods purchased or produced for the purpose of sale. So, to determine the revenue from current activity, we need to apply the following equation. Net sales minus cost of goods sold. The concept of net sales is determined according to the type of the company. As we know, we have three different types of companies: commercial, industry, and service companies. Let's see how to calculate the net sales from the commercial company point of view. These type of company purchase goods for the purpose of resale without making any industrial changes. Net sales is calculated by the difference between total and the sales return and allowance. In order to calculate the net sales from the commercial point of view, we have to apply the following equation. Total sales, either cash or on account, will be subtracted from the sales return and allowance. What is the general rule for the current revenue? The general rule, and that is very important, all current revenue are subjected to tax. Between brackets means taxable. I have to pay tax for these amounts, except the following cases. When I say the expression except means the following items are not taxable. What are the items which are not taxable? Number one, goods withdrawn by owner. But remember that we are talking about juridical person, so we have two types of companies, either partnership or corporation. So if the owner of the company is a partnership, so if he withdrew goods at sale or market price, then it is not taxable. In the case of corporation, if the owner withdrew goods either in market or cost price, they are not taxable. Remember that. In case of partnership, if the goods withdrawn according to the selling price or the market price, they are not taxable. But in the case of corporation, it is not taxable even if in market price or in cost price. The second case is the goods at agent. They are not considered as taxable because it is not a realized profit. So any goods at the agent are considered as not taxable. What about the 6,000? These 6,000 are goods withdrawn by the owner and not profit because it is recorded at the market price. So it will be revenue subjected to tax at the cost price, which is 6,000. The third adjustment, negative 3,000. Why negative 3,000? Because it's revenue recorded but not taxable. Why it is not taxable? Because these amounts are goods withdrawn by the owner sorry, its goods at agent are not taxable because it's unsold. The cost of the unsold goods is 12,000, so the profit is 12,000 multiplied by 25%, which is equal to 3,000. This amount is revenue recorded and not taxable. The force adjustment. It is 4,000 negative. Why it's 4,000 negative? Because it's revenue recorded and not taxable. Why it is not taxable? Because these amounts are sales invoices which are taxable according to the accrual basis. So any invoices related to 2000 are not taxable because we are preparing the adjustments for 2019. So it is revenue recorded and not taxable. The last adjustment is negative 450. Why it is negative 450? Because sales return and allowance are not taxable. So the difference between the selling price and the cost of goods sold, which is equal to 1,950 minus 1,500, is equal to 450. These amounts are not taxable, so it is revenue recorded and not taxable. Another example. Accounting net profit for a partnership in 2018 was 50,000. If you know that sales invoices of 15,000 unrecorded, the cost of these sales are 12,000. Purchases invoice include an amount of 21,000 recorded twice. Goods at agent recorded at 150% of their cost, part of the goods unsold costing 15,000. Goods withdrawn by the owner not recorded and its cost 6,000 when the market value is 7,000. Cost of raw material 5,000, market value 6,200, and the company reduced the material at 10% below cost. Cost of material in transit 9,000, not included in the ending inventory. Sales included amount of 2,000 for goods withdrawn by the owner, its cost 1,500. Expenses include freight in, its value is 500 paid in advance. Required, calculate the TMB or the taxable net profit. As we said before, the starting point is the accounting net profit. According to the given, the accounting net profit is 50,000. So the first adjustment is revenue not recorded and subjected to tax. Why it is subject to tax? Because the difference between the sales invoices 15,000, which is not recorded, and the cost of these sales is 12,000. So 15,000 minus 12, the difference is 3,000. This amount are considered as revenue not recorded and subjected to tax. The second adjustment. Expenses recorded and not approved by law. Positive 21,000. Why it is positive 21,000? Because it is recorded twice. The third adjustment. Revenue not recorded and subject to tax. 6,000. Goods withdrawn by one of its owner are considered as sales not recorded and must be recorded at cost, which is 6,000. The fourth adjustment, material, which is a part of the ending inventory and could be valued by cost but without any reduction. The company reduced the cost by 10%. This reduction will decrease the net profit by 10%. So I have to add it back. So this reduction will be considered as revenue not recorded and taxable. Goods at transit are goods purchased and yet not in the warehouse, are considered as part of the ending inventory. The company didn't include these purchases, so the ending inventory was reduced by 9,000, and this is considered as revenue not recorded and taxable. Adjustment number 6. The freight in is considered as an expense not approved by tax because it was paid in advance, and we know we apply the accrual basis, so it is considered as an expense recorded and not approved. The seventh adjustment. Goods at agent is revenue recorded but not taxable because it is unsold, so it must be calculated at the net value. The eighth and the final adjustment, goods withdrawn by the owner are considered as sales not taxable because it is recorded at market, so it is added after deducting cost. The second type of revenue, what we call it subsidiary revenue. What is the meaning of subsidiary revenue? These revenue are resulting from any activity other than the main activity. Sometimes we call it indirect revenue. They are not periodical, they are not repeated. This type of revenue is divided into real estate revenue. What is the real estate revenue? These are revenue resulting from leasing real estate owned by the company to other. Such revenue are subject to tax as long as these real estates are considered among the company's assets. In the case of a natural person, a real estate revenue must be subject to real estate tax or agricultural land tax, as we mentioned in chapter 1. But in the case of juridical person, all real estate revenue will be subject to the commercial and industrial income tax after deducting all the cost-related revenues. What are the type of revenue of real estate revenue? It includes renting the company's wall for the purpose of advertisement, renting one of the shops owned by the company, renting an industrial company as a workshop, renting a factory with its content, renting mechanical or electronic machines or cars owned by the company. All these type of revenue are subjected to tax. The second type of subsidiary revenue is compensation. These amounts are received by the company from others in return of damages done to the company. We need to differentiate between two cases of compensation. Compensation resulting from non-implementation of contracts and delay. According to this case, if these compensations are received in cash, then these amounts are considered a revenue and then subject to tax. If these compensations are accrual, which doesn't mean I didn't receive it in cash, then these amounts are not subjected to tax, exempted from tax. Compensation received from insurance company as a result of damage, theft, or fixed asset owned by the company is subject to tax. The excess of compensation received over the net book value of the damaged asset is considered as revenue. Also, if the compensation received is less than the net book value, it will be considered as expenses approved by tax. Let's apply the previous two laws in the following example. The accounting net profit, or the ANP, for the corporation is $67,000 in 2019. If you know that revenue of the company did not include, keep in your mind these amounts are not included in the income statement. $5,500 compensation from insurance company due to the fire to the company's goods costing $4,500. The company's revenues include $15,000 for a compensation received from an insurance company for goods stolen, which costs $14,000. The company owns a building, its book value is $600, and its accumulated depreciation is $350. Then the building was exposed to a fire and damaged completely. The company had received a compensation of $300,000 from the insurance company and didn't record the amounts in it. The company purchased goods costing $6,000 which were lost. The company has insured the goods, and it had received a compensation of $5,000 from the insurance and didn't include the compensation. The company received $30,000 compensation from insurance company for building owned by the company. The building book value was $40,000, accumulated depreciation $8,000, and the company didn't record the compensation among its revenue. Required, calculate the taxable net profit. As we mentioned before, we have to start with the accounting net profit. According to the given, the accounting net profit is $50,000. The first adjustment is revenue not recorded, subject to tax. The difference between the amount received and the cost is $5,500 minus $4,400. The difference is $1,000. The compensation from the insurance company is taxable because it exceeds the book value, so it is considered as revenue not recorded and taxable. The second adjustment is not adjustment. Why it is not considered as an adjustment? Because compensation of lost goods are taxable for the difference between the book value received, but this amount is considered as revenue recorded and taxable, so no adjustment is needed. The third adjustment is revenue not recorded and taxable. Why it is taxable? Because compensation received are taxable because it exceeds the book value. How to calculate the exceeded amount? According to the given, the compensation received is $300,000. The net book value, which is equal to the purchasing price minus the accumulated depreciation, so the net book value is equal to $150,000. The compensation revenue is the difference between the compensation received and the net book value, which is equal to $50,000. The fourth adjustment is negative $10,000. Why it is negative $10,000? Compensation received is considered as a loss because it is less than the book value, so it is considered as expenses not recorded but approved by tax. The loss adjustment is considered as negative. Why it is negative? Because it's expenses recorded and approved by tax. Why it is an expenses recorded and approved by tax? Because the compensation received are taxable because it exceeds the book value. So the revenue not recorded and taxable, the compensation received is 300,000. The net book value, which is equal to the difference between the purchasing price and the accumulated depreciation. So 40,000 minus 8,000 equal 32,000. The difference is the compensation loss, which is equal to 300 minus 320. So the difference is 20,000. The third type is collected bad debt. These are amounts considered as bad debt in the previous year, then collected in the following year. Collected bad debt is the last step in the account receivable cycle. According to the tax treatment for the collected bad debt, which is considered as a revenue or subsidiary revenue, depends on the tax treatment of the bad debt. If the bad debt was approved by the tax authority, then the collected bad debt is subjected to tax. But if the bad debt was not approved by the tax, then the collected bad debt is not subjected to tax. The fourth type of subsidiary revenue, which is subsidies. What is subsidies? These amounts are received by the company from others to achieve economic and social objectives. What is the tax treatment? Subsidies may be divided into cash or in kind. In the case of cash subsidies, they are subject to tax. In the case of in-kind subsidies, which is a type of fixed asset, we have two cases. If the in-kind subsidies are valued at the market value, then it is subject to tax. But if it is recorded at cost, it then will be exempted. Let's see example 2.8. The accounting net profit for a corporation in 2015 was 22,500. If you know that the company didn't record an amount of 3,000 collected bad debt was approved by the tax authority as bad debt. Collected bad debt of 2,500 was not approved by the tax authority as bad debt. Required calculate the tax net profit. The starting point is the accounting net profit 22,500. The first adjustment is revenue not recorded and taxable. Why it is revenue not recorded and taxable? Because the bad debt is subject to tax if the bad debt was approved as expense. So it is revenue not recorded and subjected to tax. The second adjustment is negative 2,500. Why it is negative 2,500? Because it is a collected bad debt, but this bad debt was approved by tax, so it is revenue recorded and not taxable. The fifth type of subsidiary revenue is the foreign currency gain. This gain or the variance arises from the existence of transaction with external parties in different currencies, foreign currency. According to the tax treatment for the foreign currency is if at the end of the year the difference between the exchange rate might result in a foreign currency gain or loss, these foreign currency gain are subject to tax because they are considered as realized or actual gain. But if the variance resulting from the revaluation of assets or liabilities, these amounts are not taxable because they are not considered as actual gain, so it is not subject to tax. The sixth type of subsidiary revenue is deposits and saving accounts. According to Article 47, the following are exempted, not taxable, which are return from deposits and saving accounts in case registered in Egyptian banks, return from deposits and saving accounts in the post office, return on investment certificate for saving and deposit certificates issued by the bank in Egypt, return of securities and deposit certificates issued by the central bank. The seventh type of subsidiary revenue, financial market return. We mean by the financial market return, we mean by bonds and stocks, investment funds, treasury bills. All these amounts are exempted from tax if received from the Egyptian stock market. But if received from a foreign stock market, then it is subjected to tax. The last type of subsidiary revenue is other credit revenue. According to Article 50, other credit revenue are taxable. What are the other credit revenue? Earned discount, credit sales commission, credit return. Thank you.